In this video, we are going to solve some practical questions from DK Goel, and it is related to current ratio and liquid ratio. This is the first question from DK Goel, in which we have to compute the current ratio. Here some components from the balance sheet has been given. First, we have to classify the items into current assets and current liability, because the formula for current ratio is current assets divided by current liability. So let us first classify the items into current assets and current liability. Land and building is not in current assets, it's fixed asset. Inventory, it's current asset. Trade receivables, current asset. Current investment, current assets. Trade payables, current liability. Long-term borrowings, it's non-current liability, so it's not considered as current liability. Short-term borrowings, it is a current liability. Provision for tax, current liability. Outstanding expenses, current liability. Cash and bank balance, current assets. Now, as per the formula, we'll put the value of all the current assets and current liability in the formula, which is inventory 70,000, trade receivables 90,000, current investment 35,000, cash and bank balance 5,000. In the current liability, we have written trades payable 46,000, short-term borrowings 20,000, provision for tax 10,000, outstanding expenses 4,000. So total of my current assets is 2 lakh and total of current liability is 80,000. So by dividing it, we have got the answer as 2.5:1. Next, in question number 3, I have not given the question over here. I am discussing the components given in the question. Goodwill, it's not a current asset. Inventories, it's a current asset. Trade receivables less provision. We will be taking trade receivables less provision to be current assets. Investment, short term, it is a current asset. Expenses paid in advance, also known as prepaid expenses, is a current asset. Cash and bank balance, current asset. Accrued income, current assets. Short-term provision, current liability. Short-term borrowings, mentioned in bracket as bank overdraft, so we'll take it as current liability. Trade payables, current liability. Expenses payable, current liability. So the formula is current ratio is equals to current assets by current liability. So the amount 2,50,000 of inventories, 1,30,000 of trade receivables less provision, short-term investment 30,000, prepaid expenses 20,000, cash and bank balance 40,000, accrued income 10,000. And the liabilities we have mentioned: short-term provision 20,000, short-term borrowings 30,000, trade payables 95,000, and expenses payable 5,000. Total of the current assets is 4,80,000, current liability is 1,50,000, which will give us 3.2:1 as the answer. Next, we have to find out the quick ratio from the same question. So the formula for quick ratio is liquid assets divided by current liability. So liquid assets equal to current assets minus inventories minus prepaid expenses. So one formula is from 4,80,000, that was our current assets from the previous part. From 4,80,000 we can deduct 2,50,000 and 20,000, or excluding inventories and prepaid expenses, we have written the amount of liquid assets over here, that is trade receivables less provision 1,30,000, short-term investment 30,000, cash and bank balance 40,000, accrued income 10,000. Current liability amount will remain the same as we have done in the current ratio formula. So the total of liquid assets is 2,10,000 and that of current liability is 1,50,000. So this will give us 1.4:1 as the answer. Now in question number 8, the current ratio of a company is given as 3:1, and we have to find that in each of the following cases, like this case A, payment of trade payables, what effect will it bring on the current ratio of the company? Now, as we know that the formula for current ratio is current assets divided by current liability. So we can assume that the current assets be 30,000 or 3 lakh, and the current liability to be 1 lakh or 10,000. So I have taken here to be in the amount to be in lakhs. Now the payment of trade payables, again I have assumed the amount to be 40,000. So if we are making a payment for trade payables, that means our current liability is decreasing. In one hand, on the other hand, also we are making the payment. Maybe we are making the payment in cash or in bills receivable. We are endorsing a bill to our creditor. So in both cases, the current liability and current assets both are getting affected. So if I reduce this 40,000 from 3 lakh and also from 1 lakh, so my current asset at present will be 2,60,000 and current liability is 60,000. So if I divide this amount, the answer is 4.3:1, which is indicating that after the situation, after the payment of trade payables, my current ratio is increasing. Hence, we can say that the ratio is improving or increasing. Next, from the same question, part B, it is said that a sale of good costing rupees 20,000 for rupees 20,000 for cash. Now, if you remember the accounting equation, in accounting equation, we were solving the equation applying a method where we used to see that exactly what is getting affected in the balance sheet form, whether the current assets is getting affected, whether the also not only current assets, it was about all the assets, whether the asset side was affected or whether the liability side was affected. So here also we'll be applying the same thing, only the difference is here we have to see whether the changes regarding current assets or current liability. In this case, when we are selling off goods, that means stock is decreasing, which is stock is or inventory is a part of current assets. So my current asset is decreasing. On the other hand, cash is coming in the business. So again, cash is also a part of current assets. So current asset is increasing. So if I see what changes it has brought to my current assets, you can see that from 3 lakh, cash is increasing of 20,000 and also stock is decreasing 20,000. So basically there is no change in the current assets and there was no change in the current liability. So there is no change in the current ratio also. Part C of the same question, it says sales of good costing rupees 20,000 is sold on credit for 18,000. Now sales of good, that means stock is decreasing by 20,000 and we are receiving only 18,000 on the sale. And on credit, that means we are not receiving cash, but we are having debtors now. So when debtors is also increasing, that means my current asset is increasing by 18,000. But here, the amount of decrease is more than the amount of increase. That means my current asset amount has changed a bit. That is, my current asset has decreased by 2,000. And for which, and current liability was same, there was no change in current liability, and current asset, the numerator has reduced. This indicates that my ratio will reduce. Now part E of the same question, that is purchase of goods on credit, say for rupees 20,000. So the question given was purchase of goods on credit. I have assumed the amount to be 20,000. Now when we are purchasing goods, that means my stock is increasing, and on credit means my liability is also increasing. Right now I am having a creditor. So in this case, my current assets and current liability both are increasing. So from 3 lakh, it will become 3,20,000. From 1 lakh, it will become 1,20,000. If you divide 3,20,000 by 1,20,000, we'll see that the amount will be less than 3:1. Therefore, the ratio will reduce. Now, one more question I have referred over here for showing you that what changes it will bring to current ratio if the question or if the transaction is not part of current assets or current liability. For example, what will be the effect on current ratio if the bonus share is issued? Now see, the bonus share is neither a part of current assets nor a part of current liability. This bonus share will affect the reserve and surplus, and from the reserve and surplus, amount will be transferred to share capital. So this has nothing to do with the current assets and current liability. Hence, there will be no change in the current ratio. Now, the next question is question number 11, in which the working capital has been given. So working capital, let me remind you the formula once more. Working capital equals to current assets minus current liability. It is the excess of current assets over current liability. Long-term debt is given 80,000. Total debt is 2 lakh. Now remember one thing, when total debt is mentioned, it indicates the total amount of outside liabilities. The total of the liabilities. Now in this question, see, there is no current assets mentioned, no current liability is mentioned. So what we have done is, first we will find out the current liability. How to find out? From the total debt, that is the total of the liability, I will subtract the long-term debts. From the total outside liabilities, if I deduct the long-term debts, I'll get the current liability. So 2 lakh minus 80,000, that is 1,20,000. And formula for current assets, as I have mentioned earlier, working capital is equals to current assets minus current liability. We know the amount of working capital, we know the amount of current liability. Just we need to find the amount of current assets, that is equals to current liability plus working capital. Amount of current liability is 1,20,000, that is from here we have got, and working capital was given in the question as 1,92,000. So this will give us a total of 3,12,000. So putting it into the formula, current ratio is equals to current assets divided by current liability. 3,12,000 divided by 1,20,000, that is 2.6:1. Next, question number 14a. Current assets is 4,10,000. Creditors paid rupees 50,000. After payment, the current ratio is 2.4:1. Remember, this is after payment current ratio is mentioned over here. Ascertain the amount of current liability and working capital after payment. Current assets is given in the question, so let us assume the current liability to be X. And as we know, the formula for current ratio is current assets divided by current liability. So first let us write the formula. That is, it was mentioned that the current ratio after the payment was 2.4:1. So I've written, and in the current assets, obviously the current assets will be after payment. So the current asset mentioned was before payment. So we have written 4,10,000 minus 50,000. Since we are paying the creditors, that means cash is going out of the business. And the current liability, the total of the current liability we have assumed before payment to be X. So again we will reduce 50,000 payment made to the creditor. So by cross multiplying, we will get the answer. We will get the equation to be 2.4x minus 1,20,000 is equals to 3,60,000. 2.4x equals to 4,80,000. So x, the value of x, that is current liability, is 2 lakh. But we need to find the amount of current liability after payment. So from 2 lakh, I'll deduct 50,000. This will give us the current liability after payment, that is 1,50,000. Now coming to the calculation for working capital, that is current assets minus current liability. Again, we have to find the working capital after the payment. So after payment, my current assets amount was 4,10,000 minus 50,000, which is 3,60,000. So I've taken my current assets to be 3,60,000, and current liability amount was 1,50,000. So deduct 1,50,000 from 3,60,000. So we'll get the working capital after payment to be 2,10,000. Now, question number 19. In this question, inventory amount is given as 2 lakh. Total liquid assets is given as 8 lakh. Quick ratio is given as 2:1. We have to find the current ratio. Now, the formula for current ratio is current assets by current liability. Here in this question, we don't have a current ratio, neither we have a current liability. So what we'll do is, see, total of liquid assets is given and inventory is given. If I add this two, I'll get the current asset. So first what we have done is, we have found out the current assets, that is total of liquid assets plus inventory, which is equal to 10 lakh. Now quick ratio is given. So let us take the formula of quick ratio, which is liquid assets divided by current liability. We don't know the amount of current liability, for which we have taken the current liability to be X. Now putting it in the formula, 2:1 equals to 8 lakh divided by X. From this we'll get the value of liability to be 4 lakh. Now just putting it in the equation, we know from the previous slide you have seen the current asset amount was rupees 10 lakh and current liability stood at rupees 4 lakh. Dividing this two will get the answer as 2.5:1. So this was all for today's video. I hope you have understood how to solve the sums related to liquidity ratios. Thank you.